thanks for having me. It's great. The Columbia Economics Review is still going, and I'm happy to be your first speaker of the year. And thanks to all of you for waiting for these slides to get loaded, which is taking us a while. So the talk is about a new aspect of monetary policy. Since the financial crisis, it's become much more important. It's certainly become important at the Fed in the U.S., although to some extent at other central banks as well. And I'm going to talk some about some of the uses of this new tool at some other central banks. And by forward guidance, what is meant is the willingness of central banks now to make relatively explicit statements about likely future policy decisions. And most notably, this has meant future interest rate decisions, and that's what I've been talking about tonight, although to some extent the issue of forward guidance arises in the case of other elements of central bank policy as well. And the thing that's notable about this recent development is not just central banks making statements about likely future decisions, but that in particular, in the last few years, one sees the Fed and some other central banks making statements about policy even years in advance, which is a quite remarkable development relative to previous practice. As an example of what I'm talking about, that some of you will all be aware of, the FOMC, which is the body at the Fed that Bernanke chairs, that meets 8 times a year to make decisions about monetary policy, they declared last December their intention to keep their target band for the federal funds rate where it currently is, at least until the unemployment rate falls to 6.5%. There are some other qualifications about inflation not getting out of control, but subject to those qualifications, they were declaring they wouldn't consider an increase in the funds rate until that happened. And most people expect that this wouldn't allow increases in the federal funds rate before sometime in 2015. So until more than 2 years after they first started making that statement about future policy. And in fact, the FOMC indicated at the time that they introduced this that that was likely in their view as well. And it's a remarkable kind of statement. It's not just the Fed that is making statements of that kind. For example, this past August, the Bank of England followed Fed's lead in a fairly direct way. They began with their August meeting making a declaration about future policy, saying that they would not raise their policy rate from where it currently is until unemployment in the UK falls to 7%. Again, a number of qualifications, somewhat longer list of qualifications than in the case of the Fed statement, but that was clearly intended to say something about future policy decisions. And again, at least in the view of the bank, it was implying that interest rates would be low for quite a while. According to them, it implied that they don't imagine raising the policy rate until sometime in 2016. As we'll discuss, a number of other central banks have also, at least temporarily, made declarations of that kind about not raising their policy rates. This has happened in several countries over the last 5 years, and in the relatively unusual situations that a lot of countries are facing. But it's a very unusual development relative to the way central banks behaved in the past. Why is that? Until recently, central banks were very reluctant to say anything in advance about future policy decisions at all. They might announce what the target was for their policy rate that they just decided on after they have a meeting, but they would typically just announce this is the decision for now, and understood that that could be reconsidered at the next meeting, typically in another month in the future. Sometimes it could be reconsidered even sooner if there was some sufficiently dramatic development, but you might say, well, it's saying where interest rates are going to be for the next month or so, but only for a few weeks. No promises at all about what might happen after that. What's changed? Why are they suddenly willing to make making statements about future policy, and even not just near-term policy, but about policy over the coming year or 2 years or maybe more. The most obvious thing that's different is that central banks, at least a number of central banks, in the aftermath of the financial crisis, reached what they regarded as effective lower bounds on their policy rates. So they found themselves in situations where they were already cutting their policy rate as much as they were willing to consider cutting it, if not necessarily quite as much as would be technically feasible, and nonetheless found themselves in situations where they felt policy wasn't loose enough. And to give you an illustration of what was happening in a lot of countries, this slide plots the path over time of the official policy targets for the various overnight interest rates that are used as the key policy instrument for these different central banks. The Fed is that orange line. You can see that back at the beginning of 2007, the federal funds rate target was up at 5.25%. And starting in the later part of 2007, as the clouds of the financial crisis are already appearing on the horizon, they start cutting it. They start cutting it fairly dramatically by late 2007, and all through 2008, you see it being chopped very fast. And by December of 2008, they've replaced the point target by a band, 0 to 25 basis points, that orange band, and it's stayed there. It's almost 5 years later. They just haven't moved it from that, and of course they don't have much room to make it lower than that. What the slide is showing is that's not specific just to the Fed. I mean, all of these central banks, some of them started a little later. The Fed was already chopping its target by the latter part of 2007. Not everybody was, but by the latter part of 2008, all of these policy rates are just coming down very fast. And by the spring of 2009, all of these central banks have cut their policy rates to levels that they were at least very reluctant to think about going below, something that they regarded as effectively a lower bound. Where that lower bound is varies a fair amount for the central banks. In the case of the Bank of Canada, it was at 25 basis points, a quarter of a percentage point. In the case of the Bank of England, it was when they reached 50 basis points, a half of a percentage point. In the case of the Bank of Japan, it was 10 basis points. They were going to go down to that, but they didn't, as you see, really want to go below the 10 basis points. That was steady with that. The ECB, a pretty cautious bank, didn't want, for a long time, they didn't want to consider going below 1%. But what you see is this flat region that after the spring of 2009, all of these banks have been just holding steady exactly where their targets are. And I don't think in any of those cases it's because the thing that led them to be cutting interest rates, they now think at least maybe it's going to be over, and so they don't need more cuts for that reason. It's because all of them, everyone in 2009 is saying after 2009 is still pretty worried about the situation, thinks more stimulus rather than less stimulus is what they would like to be doing with monetary policy, but feel constrained. In the case of the ECB, their traditional practice had always been to leave a whole percentage point of difference between their target for overnight interest rates and the rate of interest that they pay on overnight deposits at the ECB. And so when they cut this to 1%, it meant they were cutting the interest rate they paid on overnight deposits down to 0, and so then they thought, we're done. You can't go below that. So where that effective lower bound was different, but it was a very common thing that at least in late 2009, early 2010, all of these banks regarded themselves as having some kind of lower bound. What does that have to do with the forward guidance issue? Well, when the central banks found themselves unable, or at least unwilling, to cut their policy rates further, but in a situation where they felt aggregate demand was still insufficient, and that they felt there was a need for further monetary stimulus, if there was some way to bring it about, what some central banks were willing to do was to try committing to looser policy in the future rather than cutting the policy rate immediately. And the idea is that they would commit in advance to be keeping rates lower in the future than would otherwise be justified given conditions then. And to have this promise of looser policy later to be a substitute to some extent for being able to lower short-term interest rates immediately. What would be the point of such a promise? The idea was that if they could make people, in fact, expect the policy was going to remain loose for longer than they were previously having reason to expect, that should stimulate aggregate demand immediately. Why would that be? I mean, there are at least three different channels through which you could expect that to happen if people's expectations of future monetary policy were in fact changed in that way. One is that the expectation that short-term interest rates are going to be lower in the future is a reason for longer-term interest rates to become lower immediately. Insofar as a major determinant of longer-term interest rates is where people expect short-term interest rates to be over that longer period of time. Expecting short-term interest rates to be lower further out in the future is a reason for the dollar or whatever country's currency it is we're talking about, for the value of their currency, exchange value against other currencies to become weaker. It's a reason for stock prices to become higher, other asset prices to become higher, and all of those things are things that should stimulate current spending. Lower long-term interest rates should encourage some types of spending. For example, lower mortgage rates encourages people to be more likely to buy houses immediately. A weaker dollar encourages people to buy more U.S. products as opposed to foreign products. Higher stock prices make people feel wealthier and therefore able to spend more immediately, and so on. That's one type of channel, but also if you expect an economic boom later because the central bank is going to keep interest rates lower than you were previously expecting them to later, that expectation of higher activity and hence higher incomes in the future should be a reason to spend more now as well. If you're expecting income later, the anticipation of that should make you think you can afford to spend more now. The permanent income hypothesis would be one well-known explanation of how that would occur, but other models of saving decisions, like the life cycle model of saving, would also have the same kind of implication. A third channel is that if you were expecting somewhat higher inflation later because of the expectation that monetary policy would be looser later than it otherwise would have been, that expectation of higher inflation should make a given level of nominal interest rates correspond to a lower perceived real rate of return on savings or real cost of borrowing. And so then that would mean that even if there's a lower bound on what you can do with nominal interest rates, the perceived real interest rate that it corresponds to would become lower, and that should again encourage more spending or less saving now, and also be favorable to current aggregate demand. So for those reasons, I mean, at least in theory, it would seem this is something that could be useful as a way of stimulating aggregate demand without having to change the policy rate immediately at the time that you're having the effect. But an obvious question about it is, well, is there any reason to think that it is actually effective in practice? In particular, can the central bank simply saying something about future policy actually affect people's expectations? If they don't affect expectations about what the central bank will do, then they shouldn't affect expectations about those other things I was referring to. Hence, none of those mechanisms that I was mentioning would be operative. And the answer to that, I think, is that it depends a lot on how it's done. So the mere fact that the central bank says something about future policy doesn't necessarily mean that people will believe it and that their expectations will therefore immediately be different just because something was said. It depends on how it's said and whether the central bank is really giving people a good reason to have different beliefs about the future or not. And a way of illustrating this is comparing the effects of two different central banks' experiments with forward guidance, which happened on exactly the same day. So it's interesting thing about the comparison. The day in question is April 21st, 2009. So we're at this point on the graph in here where basically everybody has, by this point, reduced their policy targets to as low as at least they're comfortable thinking about reducing them. And this is a time when the situation of the global economy is still pretty uncertain. Unemployment is shooting way up. Economic activity is pretty low in lots of places, and so on. So the feeling that more monetary stimulus is desirable is reasonably clear. And the first example that I want to look at is the Bank of Canada, whose policy committee had a meeting on that day, on November 21st. And they issued this press release at the end of their meeting, which stated, the headline of it was, the Bank of Canada commits to hold their current policy rate until the end of the second quarter of 2010. And this is a very unusual kind of announcement, both because it wasn't just an announcement about the current policy target, it was talking about future policy. In addition to what I said about the current policy target, it uses this word commit, which is quite strong about what it's saying about future policy, and it's talking about things off more than a year in advance, talking about the second quarter of 2010. The text of the press release includes the stuff that's here on the slide. They did announce they were lowering the current policy target, the target for the policy rate by a quarter of a percentage point, from 0.5% down to 1/4%. And it says, which the bank judges to be the effective lower bound for that rate. So that's also an indication that this thing was setting. They regarded themselves as having gone as far as they could, cutting it to 1/4%. And then they say, with monetary policy now operating at the effective lower bound for the overnight policy rate, it is appropriate to provide more explicit guidance than is usual regarding its future path, so as to influence rates at longer maturities. That's one of those channels that I just mentioned to you. And what they say then is, conditional on the outlook for inflation, the target overnight rate can be expected to remain at its current level until the end of the second quarter of 2010. So that's a very dramatic kind of statement about future policy, relatively unprecedented. What were the effects? One sign of effects is this is looking at swap rates for the Canadian dollar on that day. So this is high-frequency data on the overnight interest rate swap rates for different maturities, which are essentially indicating a market forecast of the average level of that overnight interest rate over a certain period of time. So the one that's labeled 6 months down here, that's essentially the market's forecast of the average level of the overnight rate over the coming 6 months. And the 8-month is an average over the coming 8 months, and the 12-month is an average over the coming 12 months. And what you see here is that all of these swap rates drop immediately. What is the dotted line here? This is the time of the announcement of that press release that I just showed you. And so it looks like, at least the people trading in this market are paying attention to that announcement, and that their bets about where the policy rate is going to be over the coming year are immediately different. And in particular, in terms of what you see happening here, it's not just the news that the current policy rate has been cut from 0.5 percentage point to only 1/4 percentage point. And what you can see is people's expectations were not that on average it was going to be at 0.5 percentage point, at least over the coming 6 months anyway. They already were obviously putting some significant weight on it being lower than that sometime in the coming 6 months. But what happens here is not what would happen if the only news were they've cut the policy rate from 0.5% to 1/4%. That's just for this month, though, and it only changes our beliefs about where overnight interest rates are going to be for the coming month. If it doesn't change your beliefs about where they're going to be further in the future, what you should see is if there were a 1-month contract, which they don't have shown on this slide, but you would say the 1-month contract to fall, because they told you overnight rates would be lower for the coming month. But if it didn't change beliefs further in advance than the 1 month, then the 2-month rate should only fall half as much as the 1-month rate falls, and the 3-month rate should only fall 1/3 of as much as the 1-month rate falls, and the 12 months should only fall 1/12 as much as the 1-month rate falls. And so what you should see is the shorter these are, the more they would fall, and the longer ones would fall the least. And what you see here is the opposite. Not only do they all immediately fall, but the 12-month is falling by more than
say the 6 month. And what that means is that evidently beliefs about where the policy rate is going to be between 6 months and 12 months by now actually falls more than people's beliefs about where the policy rate is going to be over the coming 6 months. And so that means it's not the news about where the policy rate is going to be over the coming month that is the biggest news here. It's about that stuff more than 6 months in the future, which of course the statement did include some very dramatic news about, because they said not just we're currently cutting it, but that we expect it to stay there until the end of the second quarter of next year, which indeed should have then changed their beliefs about the average level of the policy rate over that whole period covered by the 12-month contract. So this is just showing what the reaction was in the hours right after the announcement, and it lasted more than that afternoon. Here is another look at some of the same data further on in time. This is now focusing on the difference between the 12-month contract and the 6-month contract, and in particular using them to infer what the apparent market estimate is of the average level of the policy rate from 6 months to 12 months in the future. And that falls, as I just pointed out. You can see from the previous slide that at the time of the announcement, that thing falls. The expectations about the policy rate between 6 months and 12 months in the future evidently come down. You see coming down more than 0.25%. It looks like certainly at least 0.25% immediately with the announcement. But now this is showing you it wasn't just that day. For the next 6 weeks or so, it remains at that lower level. And this is comparing it to the corresponding market forecasts from the overnight interest rate swap market for the US dollar. And whereas these two things had been similar for the Canadian dollar and the US dollar before that particular day, expectations about the level of interest rates in the US didn't come down much at that horizon. It's different behavior of expectations about specifically Canadian dollar overnight interest rates, which of course is what the announcement was about. What happens over here is there is suddenly, somewhat unexpectedly, a very strong employment report in the U.S. at the beginning of June, which suddenly makes lots of people in the markets think the Fed is surely going to be raising interest rates pretty soon, because suddenly the labor market is looking a lot stronger than before. And so what you can see is market expectations of where the federal funds rate is going to be later in the year shoot up very dramatically. And what you see here is people weren't willing to bet that the Bank of Canada wouldn't raise interest rates at all if that was coming. The belief that they wouldn't do anything if the Fed really started raising interest rates in the U.S. sharply. It doesn't go up by as much as this thing goes up, but it does follow it to some extent. The fact that it doesn't go up fully as much suggests that the promise about keeping interest rates low is maybe not, it is restraining beliefs about where Canadian interest rates will be to some extent relative to what might more normally have happened. But in any event, it's clearly people aren't 100% believing that necessarily they won't go up before the end of the second quarter of 2010. Does that mean they didn't believe what was being said? Well, there was that proviso about inflation not rising, and so they might believe that if the U.S. really does raise interest rates this much and the Bank of Canada doesn't move, that that's going to be a really big devaluation of the Canadian dollar, and that there will be inflationary pressures, and that perhaps be a reason to change policy, not because they're just ignoring what they said before. In any event, the evidence that beliefs were affected by that announcement is reasonably clear. Now, the other case I wanted to compare to that was a decision made the same day by the Riksbank, the central bank of Sweden, which, as it happens, had a meeting of its policy committee also the same day, and they announced their decision a few hours earlier because of the time difference, so it was still the middle of the night in Canada, and they were already announcing their decision in Sweden. What did they announce? They cut their policy rate, the repo rate, from 1%, which is where it had been up to then, down to 50 basis points, only a 0.5%. And issued a press release, though, which not only announced the cut to 50 basis points, but said the repo rate is expected to remain at that low level until the beginning of 2011. So again, this is April 2009, so that's not quite 2 years in the future, but even almost 2 years in the future. So you might say an even stronger statement about interest rates staying low than the one the Bank of Canada made. In addition to having a press release with a statement about that, they issued an update to their monetary policy report that they do several times a year with a new forward path for the repo rate that they showed graphically, and showing it as a flat horizontal line at this 50 basis point level until the beginning of 2011. So this is the figure that was in it. So every issue of their monetary policy report always has a figure like this showing where the path of the policy rate has been up until now, and then the projection of where they see it as its most likely level going forward, 3 years into the future. And that's this dashed red line. And it also has these probability bands around it because they want to emphasize we're not promising a specific path. This is only our current best forecast of the path. And so then there are probability bands around it saying, of course, other things can happen. But the interesting thing about this picture is that they cut it to 50 basis points now, but they're also then showing the path staying right at, according to at least their most likely scenario, staying right at 50 basis points until the beginning of 2011. So they're definitely communicating that view. They're not just cutting it now. They expect to hold it there for almost 2 years in the future. So does that have the kind of effect that you saw in Canada? Well, here's the overnight interest rate swap market. Again, with the vertical dashed line being the time at which the announcement of the new policy decision is released. And it seems that that must have affected the markets too. It doesn't sort of jump quite as immediately as in the case of the Canadian market, but it looks like that announcement had an effect after people had a few minutes to digest it. And these things don't go down though, right? They go up. So I think that was not what they expected, both an interest rate cut and furthermore than this declaration that they expected them to stay there for more than a year and a half to do. Here's another way of looking at the effect on the market's expectations. On this chart, the repo rate path that the bank published is shown, and this is the one that their previous monetary policy report had shown. So they had been saying we anticipate the repo rate following a path like that. Here, April 21st, they issue an update showing a new picture, shows it falling down to here and staying flat at 50 basis points to the beginning of 2011, and then rising only after that. The other lines on the picture are what the apparent market expectations of the future path of the repo rate were, as inferred from the futures markets. And so the gray line is market expectations the day before that new monetary policy update and that new policy decision are announced. The gray line is they were expecting this, they were expecting a cut, absolutely. But they were expecting rates to be rising again already by later in the year. And they were expecting rates to be rising pretty steeply then all through 2010. And continuing throughout 2011. And then the path announced by the Reichsbank is not like that gray line. It's this flat part all the way to the end of 2010. And what's the reaction of the markets? Then the black line shows the apparent beliefs of the markets about the forward path of the policy rate, as insofar as you can infer it from how people are trading in the futures markets. And the answer is it's higher at all those points in time. So instead of deciding, okay, we expect down here in 2010 instead of what we were previously expecting up there, they actually raised both immediately and further in the future. They raised their expectations of where where the policy rate is going. So what would be going on there? Well, one thing to notice about what was different about what the Reichsbank did when they made this announcement, they didn't say they were making a commitment. So as I pointed out, the Bank of Canada, when it did this, its press release had even in the title of the press release the word commitment. They were saying, we're telling you what we're going to do. I mean, some qualifications, but they said, we're telling you what we're going to do. They were making it clear that they were announcing an intention to behave differently than they usually would in the future. And they gave an explanation of that. There was that discussion of how they reached the effective lower bound. It would therefore be desirable to make people anticipate lower rates in the future, and so on. There was a discussion of how they were doing it, what they expected the benefits of that to be, and so on. In the case of the Reichsbank, they make it clear that this is just a forecast. And their monetary policy report always stresses, when they show this picture, the interest rate path is a forecast, not a promise. Well, of course, because they're saying it, depending on what happens, will do different things, but they're certainly not saying they're promising to do anything, only that this, for whatever reason it is, this is currently what they're forecasting. So if people in the economy who have their own forecasts of how they think the bank is likely to behave, if they don't believe the forecast, the fact that the bank announces a funny forecast is not necessarily a reason for them to change their beliefs, because it's not a declared intention to behave in a different way. Why did market expectations in fact change in response to the announcement? Well, I think they changed as a result of the part of the announcement that was in fact news about the Reichsbank decision rules. There was some news about the way they make decisions, and therefore how they're likely to make decisions in future meetings. And the news was that they evidently are reluctant to go below 50 basis points. And that was news. Nobody knew that. As you can see, the markets were expecting a bigger cut. They were, on the whole, people thought they would probably cut down to, say, 25 basis points at this meeting. And so that was a surprise that they didn't. But not only did they not do it at this meeting, but they draw that line. And they said stuff about operating it up. They said in the press release, with a repo rate at this level, the traditional monetary policy has largely reached its lower limit. So they were not just for this month only cutting to 50 basis points, but they were making it look like they believed there was a lower limit there, and they were going to be, stuck up against it. They were not thinking of wanting to raise rates, but they were going to be there at the constraint. So that was news that they don't believe they should ever go below 50 basis points. And given that, then the adjustment of expectations is toward actually thinking that rates are likely to be higher than people were getting before, rather than thinking they're lower. So I don't think it's evidence that the announcement about future policy didn't matter. It doesn't look like the statement was ignored. I think, though, that what markets react to is the information they could extract that would allow them to better forecast how the central bank behaves. It's not what the central bank says, I want you to believe this picture. It's what is the central bank revealing about how they think. And then based on that, what forecasts do you make about what you're doing as you imagine the future unfolding? So the lesson I think that one should draw from this is that effective forward guidance is possible, but it requires that the central bank make declarations about how it's going to act in the future, not just forecasts of what it thinks or it would like you to think is going to happen, but actual statements about how it's going to act. I think the clearer it can be about how decisions are going to be made and why, because if they explain why they intend to make them that way, that would make it more credible that you see how it is that they should make them that way, and harder for them to wiggle out making them that way unless something genuinely unexpected has happened. I think if they are clear about those things, then it's more likely that listeners should be persuaded to change their expectations. And so I think a similar issue may help to explain the difference between the apparent effects of the Fed's current form of forward guidance and the superficially similar communication by the Bank of England that I mentioned at the start of the lecture. The Bank of England, since last summer, has been saying something that looked like they were directly trying to copy the policy of the Fed. The Fed's policy, I think there is some reason to think that it's one of the things that's been helping keep longer-term interest rates low, and certainly apparent market beliefs about the future path of the federal funds rate are consistent with markets basically believing the view the Fed is expressing about that. In the case of the UK, this doesn't seem to have happened. Market pricing seems to suggest that people in the market see the Bank of England raising its policy rate much sooner than 2006. It says it thinks that it forecasts not raising it before then, and it seems people don't believe that, and this statement about the 7% unemployment rate didn't change too much what people seem to be believing. What's the difference there? I mean, I think there are some differences. I think the Fed has taken some pains to declare that it is committing itself to keep rates low, and to do that for a time longer than it usually would. That this is not just a statement about not reconsidering raising rates until certain things happen, but that this is not just what would be dictated by the type of Taylor-type rule that they've followed in the past, but that they're definitely declaring an intention, at least in the near future, to behave differently. One of the things that shows this is that since last fall, they've declared several times that the federal funds rate will remain low for a considerable period, even as the recovery strengthens. The point of putting in that language in those meeting statements is to indicate an intention to behave differently than their past reaction function would have dictated. In the past, people would have expected that if economic activity picks up, you immediately raise interest rates, and they're saying, no, we're going to keep them where they are, even as the recovery strengthens, meaning an intention to depart from their normal reaction function. What did the Bank of England do? I mean, they said something that sounded similar to the Fed's statement, but as soon as they made that announcement, it was accompanied by statements by several of the top Bank of England officials declaring, they were explaining to the public, what is this new thing, this forward guidance about? Several of them gave speeches declaring that forward guidance was merely intended to explain what the bank's usual reaction function was. They said it's not that we're changing our behavior, we're just making sure the public understands better what our usual reaction function was. In fact, they explicitly denied that it was intended to inject additional stimulus by pre-committing to a lower for longer policy path. Don't want anyone to think that's what we're doing. So they were explicitly denying they were trying to do the thing that was supposed to be the point of the Fed's commitments. And one of the things they've said in these recent speeches is, don't think we're doing that, because of course we couldn't do that because Bank of England procedures would not make it possible for the committee as a whole to bind individual members to vote in any particular way in the future. So we couldn't bind anyone in advance to vote in the future differently than what they think is right, what their conscience tells them to do at that future date. But of course, if that's true, then the announcement shouldn't change anyone's expectations about future policy other than what understanding you have of what their normal reaction function is. And evidently, people's understanding of that reaction function is they don't think it would lead them to keep interest rates low. 2006. So given this aspect of the way the Bank of England has explained the meaning of what it's saying, I think it may not be surprising that markets haven't been too much influenced by the bank's statements about how long it is currently forecasting that their policy rate should remain low. So again, the lesson I would be inclined to draw from this is not that forward guidance is pointless or powerless, but that it's not a magical thing that just because the central bank says something, then of course people must believe that because they said it, and then all the economic consequences follow from people really believing it. They have to be giving people a reason to believe that behavior will be different than they would have expected it to be before. And to do that, they have to talk about it as if they're declaring an intention, and they have to they have to have clearly made up their own mind that they really are going to behave in a certain way, and furthermore try to explain that to the public. And doing that is obviously not a simple thing. I mean, I think it requires central banks to rethink the way they make their policy decisions, maybe to a greater extent than some of them are yet. So thanks for coming out.
We'll now just open up for like about 30 minutes of discussion, so feel free to ask any questions you may have for Professor Woodford, and let's start.
Yeah.
Are there any actions that the Fed in the U.S. could take to strengthen forward guidance within the framework of what their policies are now?
I mean, I would say they haven't done absolutely everything they could. I mean, to say that there is something big they can do with a lot more stimulus, I'm not sure that's right, because I think that they have been using forward guidance reasonably aggressively, and I think there's some reason to think that markets are on the whole believing that the federal funds rate is not likely to be rising, at least for the next couple of years. And so there is a question about sort of how much more could they hope to change people's expectations. But I think that doesn't mean there's nothing you can do. And one thing that, for example, we observed this summer was that when members of the FOMC started making statements about at least considering the idea of slowing down the rate of asset purchases, not that they're doing it yet. It was under discussion. It was very likely that it wasn't too far in the future. And there was a fairly significant bond market sell-off when they started talking about that. And one interpretation, I think, of what was going on there is that may have made people think that perhaps they were wavering in their determination to really keep interest rates low for so long. And I think it was not the intention of anyone who was saying that to also be announcing something different about their intentions about raising the federal funds rate, but in terms of the way it was perceived, I think it was maybe not an entirely even surprising thing that people would say, oh, well, if that means they are slowing down the rate of asset purchase, that was taken as meaning they're trying to withdraw accommodation. They're evidently very optimistic about the degree of progress in the economy. And of course, they were talking that way. They were saying a lot about how there's definitely been a lot of progress since last year in labor market conditions improving. And when they could hear that, you might think, okay, that means we're closer than I realized to them interpreting the situation will allow them to raise the federal funds rate. And you say, well, hadn't they already said they won't raise it until unemployment reaches 6.5%? I mean, yes, but that doesn't answer everything about when they're going to raise it. In particular, there's been a lot of discussion recently about the fact that the unemployment rate is falling, but a lot of the reason it's falling is because of people dropping out of the labor force as opposed to more of them finding jobs. And that raises the question of, well, when you reach 6.5%, is that as much progress as you might have thought it was back when you first named the 6.5% number? So there are questions about things like that. And I think in that context, if you thought, no, they don't think the progress of labor market is very good, even though the unemployment rate is falling, then you might think, okay, we'll get 6.5%, but that doesn't mean we're raising rates yet. If they say things that make you think, oh, they evidently, even if I don't know if I would call that improvement in labor market, they evidently, in the Fed, they evidently think the labor market is really improving a lot. If you think you're learning that, then you think, okay, when it hits 6.5%, they're going to say, great, achieve what you said, and so it is time to raise rates. And, so there is room within what they've said for people to be thinking maybe the increases are coming sooner, or thinking they're coming later, and so there is more you can clarify. In particular, you can clarify more about, is it really, should one think that when we get 6.5% unemployment, that does mean the interest rate increases are coming? And there are various ways, if you think you don't want people to think that it's too likely that they really come as soon as that, there are various things you could try to say about clarifying that, and they've said some things about saying, well, of course, we'll look at indicators and things like that, but that's not very specific about whether you should think they will or they won't raise interest rates when you reach 6.5%. An idea some people have mentioned is they should make a declaration about the behavior of inflation as well as about the behavior of the unemployment rate, and say that, well, even if you get the unemployment rate down to 6.5%, if inflation is running really low, then you wouldn't consider raising interest rates yet. That'd be something that they could say something about, but haven't yet. Or you could clarify what you're looking for in labor market conditions also in a way that would make it clear that some other things have to have happened besides an unemployment rate, which is technically at 6.5%, in order for you to think you've reached the point at which you were promising not to raise interest rates before. So I think there are more things that can be said, and that becomes more relevant the closer we get to that. As unemployment falls, now just having said you won't consider it before 6.5% unemployment and not really saying too precisely what happens when you reach 6.5% unemployment, suddenly that's not nailing down expectations as much as you could if maybe you filled in some other details, either about how exactly you're going to look at the labor market conditions, or maybe about whether the way inflation is running isn't going to also be important, whether it's time to raise rates. I don't know who's next. Maybe you should call it. Say who's next.
So where do you see optimal control as kind of fitting optimal control ideas and fitting in between like forecasts of future policy or more towards communicating the action function?
So there are some speeches by Fed officials. Janet Yellen in particular has published some showing the outcomes of optimal control. She calls optimal control exercises as a way of judging how fast it would be appropriate to raise the federal funds rate. And what's going on in that kind of exercise, and that's an exercise with an economic model, the FRB-US model that they have at the board in Washington. But the kind of exercise that's being asked there is they're feeding in different possible paths for policy, extending years into the future, and asking what that whole anticipated path then for the economy is associated with that, taking into account the anticipation effects of what you're doing later, and then asking which path you like the best. And so when she does that, she compares the optimal control path with what, say, some simple Taylor rules would imply. And the point of the optimal control path being different is exactly that what the picture is supposed to be showing you is that when you do that optimization exercise, you would pick a path that keeps the federal funds rate low for longer. The consequence of that is that you're doing something that the simple Taylor rule would not say is optimal later, and it would involve unemployment being lower for a while than even what you think the long run sustainable level of unemployment is. You'd be overshooting where you expect unemployment to eventually get back to a little bit and then coming back, and inflation going up a little bit more than what you want its long run value to be, and then having to come back as a result of this. So it's the thing that's being called optimal. The solution to the optimal control exercise is involving this deviation later from the thing that would best achieve the Fed's targets later for the sake of the anticipation effects. And what the simulation is showing you is that associated with that is not as high unemployment now and in the coming year because of that expectation of keeping rates low for longer, and not as much disinflation now because of expecting to keep rates low for longer. So really what that's illustrating is that's a quantitative illustration with a model of the thing that I was just telling you more informally is the idea that committing to keep the rates low for longer than people would otherwise have expected, say because they expected you to follow some Taylor rule of the kind that in the literature has been descriptive of past Fed policy, changing that expectation about how rates will be set some years in the future is, according to that analysis, giving you less unemployment in the coming year, less worry about undesirably low inflation in the coming year. And so it's exactly an illustration of the thing I was saying, and it's suggesting that giving people a reason in advance to think you'll behave in that other way rather than expecting you to follow that Taylor rule, which looks like historical policy, would have benefits. So I would say it's actually very close to arguing for the desirability of forward guidance. In fact, the point of some of those speeches was exactly to explain why would we say we wouldn't raise the federal funds rate until unemployment is at 6.5%, saying, ask, well, in such an optimal control exercise, does it indeed look like you aren't raising the funds rate until unemployment is around 6.5%? So the point of that was to say that in that kind of exercise, the policy that looks like the best you could do would have some of the features of the kind of commitments that the Fed can make into this forward guidance.
My question was very similar.
So it seems to me that this policy that the Fed's using is a lot more about like mind games and psychology than the other policy it has. So considering that, what exactly is the Fed's, like the Fed's audience in this case, I'm guessing, are like market makers. And how exactly do you think they actually react when the Fed makes these announcements? Do they actually react the way you were presenting at the beginning of the speech, like they're considering future interest rates or something like that? Do they actually react that way, or are their reactions less important and is the public's reaction much more important?
Well, I mean, of course, they're both important. If you're asking who pays really close attention to statements of the Fed, and in particular if they're complicated, subtle parts of those statements, who would actually notice that? I mean, the answer is, well, they're trading in the bond market and futures markets and things like that. They pay very close attention. The general public is saying that because the Fed makes a statement day, that immediately the public thinks something different about the future is much less plausible. When I mentioned those mechanisms before, I mean, some of them are more important depending whose expectations it is that change. The one I said first, and the reason I said it first is the most obviously important one, is I said that a bunch of different asset prices should all be affected if you change people's expectations about where short-term interest rates are going to be extending in a couple of years into the future, and that all follows just from how people, these professionals in the financial markets are trading. And I would say, well, they pay close attention. There's the question again, so what do they think they heard when you say it? But that they are in fact listening closely and arguing with each other about how to parse what you just said. A whole lot of attention is being paid to that, and if they reprice asset prices immediately because of the statement, then that does matter for the rest of the economy. It doesn't only matter for the financial markets. It certainly matters a whole lot for people who have made bets in the financial markets, of course, but it doesn't only matter for them because other households will notice that. Other households may not be paying attention to the Fed much, but if mortgage rates go down, then they see that, right? At least if they're at all thinking of being in the real estate market. They do look up what's happening to mortgage rates. If their stock portfolio goes up, they probably pay attention to that. They say, great, and they feel in a better mood about spending money on things. And, so it's not that it doesn't matter to the economy. Probably the most important way the behavior of other people in the economy gets affected is by financial market prices changing, and the way they get changed is they have to be paying attention to what the Fed says. So if you're asking whose mind are we talking about, we're talking about the mind of people that are professionals.
I wanted to ask you about forward guidance coming out of the somewhat abnormal, relatively low interest rate environment that we have, and it seems that forward guidance only came in because you couldn't lower interest rate too low and you needed that for a significant amount of time. But when we come back to somewhat more historical interest rates, we're going to go out to 3, 4, 5, 6 maybe. And what will be the role of forward guidance then? Would the central bank still need it, or do you think that's going to kind of be a weapon like quantitative easing, for example, only used in crisis?
So we don't know that. I mean, that'll be an interesting question to see about what happens. The intellectual case for thinking it could be a useful tool is one that doesn't only apply when you're at this effective lower bound on interest rates. That's a case where I think it's pretty dramatic and obvious why it can benefit you to be using the tool. it's not the case that it only matters then. The reason why, in principle, it can be useful all the time is that expectations about future policy, in fact, matter all the time. If you ask, how does the Fed have any leverage even over the economy, I think an awful lot of the effects of what it does all the time proceed through the consequences for how assets are being priced, which depend on guesses of people in the financial markets about what the Fed is going to do later. So these beliefs about what the Fed is likely to be doing later are always a lot of what they're actually affecting. It's just that in the past, they wouldn't affect those by talking explicitly about future policy. They would announce the current decision and let people in the markets figure out what that might imply about the future. And of course, what people would often be inferring is if they unexpectedly raise rates, then they think, oh, that's the start of a tightening cycle. They raise them some this time, that makes it a lot more likely that next time they may raise them even more, and the time after that raise them further, and and they can make their guesses about how far it's going to go. The Fed wouldn't say anything about that, but based on your familiarity with the way they seem to behave, people would form their inferences, and so when markets would move a lot when the Fed announced something that wasn't expected, a lot of that effect would be coming from people changing their beliefs about what it implies about future policy. It's just the changes didn't occur through the Fed actually saying anything explicit. Now you say, well, so do they need to say anything explicit? Why don't they just let people figure it out for themselves, which is the old-fashioned way? Well, it depends how accurately you think people can figure it out for themselves. And if the situations that arise are pretty repetitive, you might think, yeah, they can learn what the systematic pattern in our behavior is. They can learn what it means when we do or do not act on a given occasion, and they'll figure out all the implications about how things unfold after that because they've seen it happen so many times. Okay, that's particularly unlikely whenever things a little more unusual happen, and so you don't think you should know how to correctly expect what you think would be a correct view of what you intend to do. Of course, that arose when we hit this lower bound because that was a very unusual situation, but it's not the only way a situation can be unusual. So anytime you think that what you're in fact intending to do and what you would like people to understand about policy going forward is not something that's completely obvious because it's such a familiar situation. I mean, in any of those cases, there would be a potential advantage to actually talking about your policy intentions. Another reason why, in general, it's at least in principle valuable is because talking about future policy can allow you to commit yourself to a different approach to policy than the one that you yourself would be tempted to undertake later. And if you ask, well, would you ever want to commit yourself in advance? The answer is yes. I mean, quite generally, there can be advantages to committing yourself in advance to do something different than what you would otherwise feel like doing later. And the reason is because expectations matter. If expectations about what you're going to do next year matter now, then in fact, taking actions now that will, to some extent, constrain what you'll do next year can have a benefit of changing the expectations now, and you instead say, I'm going to do whatever seems right next year. I don't have to say yet what that is. Then when next year comes, you're not thinking anymore about what you wanted people to expect the year before, and so you don't internalize those effects on conditions before. And that matters more at some points in time than others, but it's always an issue. Now, when you hit the effective lower bound on interest rates, it's a particularly obvious issue because then you have this case of it being pretty clear that you can't get more stimulus where you are. If you could just make people think policy is going to be looser next year, that could really help now. But at the same time, obviously it's a consideration that won't give you any reason next year to be conducting policy different. The fact that you really wished right now that people would have expected it to be looser. And it's obvious that also then making a statement now that you will in fact behave differently next year than you otherwise would have might accomplish something, but the logic of that is something that could arise all the time because expectations are always, I think, a big part of the effects of policy, and to the extent that that's true, that means there's always this question of, well, how do you necessarily internalize in your decision-making process
making policy in a way that would give people a reason to expect earlier the kind of expectations that are in fact useful. And clearly central banks have some understanding of the general issue. The popularity of inflation targets, which now the US also has an official inflation target, but over the last 20 years, I mean, many central banks around the world have decided to become more explicit about their medium to long run targets for inflation. I guess what's the point? I mean, that's talking, right? That's talking about future policy. What's the point of talking? Just do what you do, and don't make declarations about what your future targets are going to be. I mean, what they've decided is no, there's a benefit to making those declarations. Why? It's a way of tying our hands in the future. Because we said this in the past, it's going to affect how we behave later, and we realize that there are benefits to having people be able to anticipate now something about that later behavior. So I mean, that's always an issue. There's a question of how big the gains you think are, and compared to the complexity of getting the forward guidance right. But in principle, it could be relevant even on the effective lower bound. Now, the question is, will they do it? We know in the past they didn't. They were very reluctant to go anywhere close to things like that in the past. It took this situation of being at the lower bound to get the Fed to think differently about that. On the other hand, now that they've done it, in the future, even if the economic situation is a lot like what it was 10 years ago, there'll be this different history. Namely, they've done this, and if when they look back they decide it worked, then that'll be easier to contemplate using the tool in the future than it would have been 10 years ago when you see a really crazy, scary thing that no prudent person would come near. Right? So we have to see, though. We have to see the post-mortem on what the historical judgment is on the current policy, and then what the consequences that has for what kind of things they're willing to contemplate doing in the future, when hopefully we will get back to an economy which is more normal than the one we've been in.
But a question, like you were talking about the bond market sell-off in the summer. So before that, yields on a lot of historically risky instruments were really low. Do you think that stronger forward guidance by eliminating some of the uncertainty surrounding like interest rate markets could actually encourage people to do things that maybe they shouldn't be doing, and actually introduce like maybe more risk at some point into the economy if too many people are pouring money places they shouldn't be?
I mean, that's a concern that some people have raised. I mean, I personally am not convinced that there is that there's strong evidence of it, but it's something you want to think about. I mean, I would put it under the heading of saying, when you think about making statements about future policy, and so you're hoping to set expectations about future market conditions, you want to be careful that the thing that the way you're affecting people's expectations is ways that you want to. You don't want to make them think that they can count on things that you don't really need them to count on. And so if you're talking about them believing that certain risks are not important because you really intend to create conditions in which they won't be important, well then it isn't dangerous for people to believe it. If you're saying people might believe you're giving them a safety net that you have no intention of giving them, but they're going to mistakenly believe it's there, then they're going to make decisions that ex post they're going to regret having done, well you should be worried about that, right? You don't want your communications to have fooled people into taking decisions that in fact are going to turn out good and bad things that are done. And so obviously, before talking, you have to think about what might people think they're hearing and make sure you're not giving them some reason to hear things that you don't intend them to hear, or it wouldn't make sense for them to think, but someone might think there's an easy inference, mistaken, but an easy inference from what you've said. And so you want to think somewhat defensively that way about including about what might be possible misinterpretations of what you're saying. But I don't think that I would say that's a reason not to try to create expectations. I mean, if you say, should you tell people the future is really scary, because then they don't take these speculative bets, and I'm not, I think on balance that's probably not helping the economy to create a lot of fear about
that everything's going to be out of control, just so nobody borrows very much money to take speculative bets. But you don't want them taking bets that, in fact, don't make sense because they think you've told them risks don't exist, when in fact you think a correct understanding is they do still exist. So you want to think about what people will hear and make sure they're not hearing something wrong as well.
One quick question. So it's twofold. One is about kind of this, let's say Congress, the fiscal scenario right now. If you have a Congress that and an executive office that's going to do, let's say, whatever you want to do, what would be the optimal fiscal policy for them in coordination with the Federal Reserve to help the economy at this moment? And the second one is more relevant to the current events with the nomination of Janet Yellen as the next Fed chief. What do you think will be her exit strategy, if there is one, to unwind the QEs and interest rate going forward?
So those are both big questions. The first one is reasonably far off the topic of monetary policy. The second one is germane, but it's not an easy question because I can't read your mind, and it's also not a question that has a simple answer. In terms of what I expect from Janet Yellen, if she's the next Fed chair, which seems quite likely, I don't see big changes from the way policy is being conducted by the Fed currently. She has been in the system for a long time, but in these last few years, she's been vice chairman. She's been right at the center of all the important discussions, all the decisions that have been made. She's signed off on them. I'm sure there's nothing that she disagrees too much with in any of these decisions that the majority bloc of the Fed have taken recently. And so the idea that it would be some surprise that now that she's in charge, policies will be done in a different way, I think that's unlikely. I think it's unlikely both because she's been part of these decisions. It's also unlikely, at least in the near term, just because whenever a new chairman comes in, I think in the beginning, one of the biggest concerns they would typically have is just reducing uncertainty, because people are always asking, my God, a new person, anything can happen now. What you see, when Alan Greenspan came in, people were really scared of him, and when Bernanke came in, people were really scared of him. And sort of the first thing you need to do is try to reassure people that come on, nothing will change, because I know what I'm doing, and that means I'm going to do what we were just used to from last year. So the idea that anything very unexpected is going to happen in the first months, at least, I think that's, even with someone who is not already an insider and part of the decision that just been made, would be unlikely. Given that she is, it's even less likely that there could be some change in approach. Now, if you ask me, does that tell us how they're going to unwind the current position? Unfortunately, it doesn't, because I don't think there's a very clear game plan. The committee, as it exists, has already announced, and in fact, the water has become muddier recently, relative to what I've seen before. So it's hard for me to tell you exactly how they're going to do it. Are they going to have to reduce the rate of asset purchases? I mean, I think, yes, I think they're going to have to hand them for too many loans. The reason for that is just that I think a lot of people there are somewhat nervous about how big the balance sheet's getting, and each 6 months that go by, you have another $500 billion of assets, then those concerns just grow. Regardless of what the state of the economy is, those worries both larger the bigger the balance sheet gets, and so I think that I'll be surprised if we get too far into 2014 before they indicate that they're slowing purchases and that the end is in sight. Now, that's a long way from then being back to a normal situation with the balance sheet. additional purchases are pretty likely to end before too long. The balance sheet may be very large, though, for many years. In fact, from what one can guess from the signals they have given, in the last few years, they haven't been talking much about any intention to rapidly normalize the size of the balance sheet. Back in 2011, they were still talking that way. They were telling people, they were not only talking like they were not going to be any more purchases, but they were talking about the fact that they were indeed, before too long, going to be selling off assets, and they were saying once we're ready to start, it'll only take 2 or 3 years, and we'll have the balance sheet back to the size it was. And they were saying, we're certainly going to get all these mortgage-backed securities off the balance sheet, we're going to go back to just holding treasuries. They were saying lots of things about the desire to get back reasonably promptly to the kind of balance sheet they had before the crisis. And it's been a while since you've heard anything like that. I mean, I think I'm not expecting that they're going to move too fast in terms of going back to a balance sheet that looks like where it was 6 years ago. But that there is still an expectation of normalization, I think is right. It is very likely, but it's probably going to be a slow process, and that means one of the big challenges the Fed faces in the nearer term is it's quite likely that they are going to need to start raising interest rates long before they have gotten back to a balance sheet that looks like what it used to look like. So that's going to raise interesting questions about how they manage monetary policy when they move into a period where they still have a more than $3 trillion balance sheet, but they don't want the federal funds rate still at 0 to 25 basis points. They want it to be several percentage points. That's likely to be a challenge. She's going to be helping the Fed figure out how to find its way through it. It's going to be another example of going into previously experienced territory. So there'll be a lot of interesting developments, I think, while she's chairman.
Yeah, about 10 more minutes for questions.
How successful do you think the Fed has been at generating high inflation expectations at the lower zero bound, and how can the Fed add more credibility to committing to a higher level of inflation?
So I don't think that they have done much to create higher inflation expectations. I would say, on the whole, they've done everything they could not to. For example, I mentioned the commitment to keep interest rates low longer than you would have ordinarily expected to given their past reaction function. But when they did that, they were important to include qualifications, which I didn't say too much about, but they included qualifications about both saying this is on the assumption that inflation doesn't rise and that our projections of inflation a couple of years in the future don't rise to more than 2.5%. So they were, they're not expecting that to be too likely that inflation is getting out of control, but they were certainly declaring that don't think that our policies are going to let the inflation rate rise. They were saying the opposite, that everything we're saying is not implying that the inflation rate is going to rise. So when I mentioned those mechanisms through which committing to looser policy later might stimulate spending now, I mentioned one idea, which is that expecting more inflation later would give people reasons, arguably, to spend more now. But I listed that one last. And the reason I listed it last is, well, this one I think has the least to do with what they're trying to do with their current policy. I would say they are hoping they don't need to rely on that mechanism. They're not trying, indeed they're trying not to have anyone's expectations of future inflation higher. And you say, how is that consistent with saying policy is going to be looser? Well, I think their belief, and the House view, at least most of them, is that there's lots of room for low interest rates to stimulate higher activity and lower employment before that's going to be generating inflation above their target, because inflation is running below their target. So even if success of the policy brings inflation up, I mean, that's fine. They said they want it to be 2% a year, and we're not there. I think their hope is that the things they're saying, and that they want people to believe about the effects of the future policy, aren't going to require inflation going much above 2%. So they're not really trying to say you should understand we would let it go beyond that, and that that's how we're trying to stimulate activity. They're really not wanting to rely on that channel.
I was wondering if you could comment on, I guess, what you might see as the future role of NGDP targeting.
Well, I don't see a lot of signs that they're going to adopt it. It's an idea that I think would have had some big advantages, and I reasonably sure that there's been at least some discussion of the idea, because certainly some of the people on the committee there understand the proposal, and I've talked to some of them about it, and they assured me that none of their colleagues will ever buy this. They say they have some sympathy. They say, I know it would never fly, so I'm not going to push for it. So I haven't seen signs that it's likely to be adopted. Now, I think it would have had advantages over the kind of thing they did decide to do, which is at the end of last year when they decided to make a statement about keeping the funds rate low, in terms of future economic conditions that had to be reached before they would consider raising the funds rate. They did that by referring to this unemployment threshold of 6.5%, together with the qualifications about inflation not getting out of control. I would have suggested, say that there's a path for nominal GDP that you want to catch up to it. As long as you're still below it, you should keep interest rates as low as you can, as long as you're well below it. As you catch up to it, you can start raising interest rates so you don't shoot past it. You should try to close it. On that path, why would I have preferred that? I mean, one reason is because it would be a single criterion, which would take care of both indicating that you care about the real economy, but that would also indicate that you're not going to let inflation get too much out of control either, but not by saying, there are these two things, we have to watch them both at once, and it's not entirely clear how we balance them if they're pulling us in opposite directions. We have a single thing. It depends on how fast the money prices of things are going up, but it also depends on the volume of spending in the economy, and it would be a single number that would say how you're balancing the two considerations. The other thing I think would have been a big advantage of it is it would solve a problem that worries me about the approach that they took, which is that they're declaring that in the near term we're going to do this approach to policy, which looks a lot different from the way we conducted policy in the past, and that is also presumably different from how they want people to think they're going to conduct policy further in the future also, except that it's a little unclear, so it's different. Now things are different than they were in the past. Who knows then what they're going to be in the future, because this seems different from the past, this seems different from what they want us to think about the future. It raises questions about how you get a transition from this kind of approach to what you want people to think they're going to do in the future. The advantage of the nominal GDP target path is you could present it in a way that would stress continuity. It would say, well, in the past we didn't talk about the target path, but if you looked at what we did, basically we're using our available instruments to keep nominal GDP on a pretty steady path. We fell off that path. We didn't want to, but it turned out that given what hit the economy, our normal tools didn't have enough traction to keep us from falling well below that path. It wasn't desired, but it was the best we could do. Given that we've fallen off the path, now we're going to go through a period of needing to catch up to get back to it, and that's going to require unusual measures while we're in the mode of catching up. But when we get back to it, what should you expect us to do? You should expect us to be trying to steer along that path again. And therefore, policy goes back to looking like it looked before we got knocked off the path. And so I think that would have the advantage of talking and making it clear why, in the near term, you're not expecting to raise interest rates anytime soon, but you would be explaining it in a way that didn't make it look like you just threw out the window all the things you used to care about, and that would make it clear what people are supposed to expect happens after you reach the point when interest rates would become higher than 25 basis points again. What are they supposed to expect about that? You'd be talking about it in a way that would
stress the continuity between the three different points in time. I thought that was a neat idea. It seems that it's not the kind of thing that's impressing too many members of the FOC. So I wouldn't tell you I see it coming as the thing that as soon as we have a new chairman, that's what he's going to pull out of the pocket.
So as you mentioned, a lot of the decreases in the unemployment rate can be attributed to decreases in labor force participation. Given that, do you think there's room for other metrics such as non-farm payrolls in forward guidance?
Yes, I think there obviously is. And as I was saying, I think there is some vagueness about what they've said so far. And as we get closer to the point where unemployment will be near 6.5%, that vagueness, becomes more and more important. And then the question of whether you know what you should be expecting of policy or not gets shaky. And so there's certainly room for clarifying it. And the way you would clarify what happens then is, as I pointed out, there are at least two obvious ways that you can clarify it. And one would be to introduce other considerations like talking about the inflation rate, apart from what you're looking for in labor market conditions. But there's obviously room to try to clarify what kind of labor market conditions you're looking at, and say that before it was enough to say we wouldn't do it before 6.5% unemployment, and that was enough to tell you that we certainly weren't there. We're not going to be there for a while, but as we get closer, now we need to say more. So now we need to clarify what kind of things we're going to look at to decide whether we've reached the labor market conditions that we were talking about when we said we wouldn't raise the funds rate until certain things happen. And so that's certainly a statistic they pay a whole lot of attention to. There's no doubt that that's one of the numbers they would be, in fact, looking at closely. And there's a question of what exactly they would say about it. What they have said so far is you find language in the FOC statements saying, we will consider many indicators, not just the unemployment rate. And it's not more specific than that. What exactly that means they'll consider and how they would, what exactly they might be looking for. But that they are likely to look at other labor market indicators seems likely, very likely. And the question is, will they find a way to say more about it